on today with putting the spotlight on wealthtech platform Stable Money that is recently in the spotlight as they've raised close to $5 million in seed funding led by Matrix Partners as well as Lightspeed. Joining in right now is Harish Reddy. He's a co-founder at Stable Money. Good to have you on board. Thanks much for joining in at a time when we're talking about a funding winter of sorts and the fact that we have seen funding drying up. Congratulations on this fundraise, marquee investors at that. Give us a little bit more background as to who are the other investors that have participated and what this funds will be utilized toward.
Thanks a lot for having us. I think this is a tremendous vote of confidence in the vision that we are building, that we could raise a $5 million seed in the funding winter. So we have Lightspeed partners, Matrix partners co-leading the round, and we also have Ashwini Vaishnav and Titan Capital that have participated in the round. We also have 40 other angel investors, including some of the biggest founders in the country.
Okay, fair enough. What is the game plan then down the line? Can you just talk us through how you're going to really expand your overall operations? I believe you're looking to use the funds as well to build technology and data infrastructure.
So we're using the funds to build the team, B, build partnerships with a lot of banks and financial institutions, and C, bring in the right kind of tech infrastructure to have seamless experience for our clients. So at Stable Money, we are trying to build a go-to platform for fixed income investment in the country. We've seen a lot of people talking about equity investments. There's a lot of focus on equity, that fixed income is lost in the process. We believe that fixed return investments is a very critical part of everybody's portfolio, and it also aids in improving the overall returns of one's portfolio. So we at Stable Money want to launch a suite of fixed income products, and at the moment we are starting with FDs. We partnered with a few banks and NBFCs, and we provide a seamless digital FD booking experience where one can start with a minimum investment of 1,000 rupees. So going forward in the next 2 to 3 months, we want to take the number of our banking partners to more than 10, and down the line we also want to add products which complement FDs like online bond investments and also debt mutual funds.
Okay, so just break it down for us then a little bit more as to what exactly the company does, because I understand that you're offering fixed return asset investment products for retail investors. Give us a little bit more perspective as to how that works.
So fixed return investments can be divided into 3 or 4 broad categories in the country. I think the most simplest form of that is a fixed deposit with the banks. So right now, when we look at the market, there is a gap of access and awareness. So A, people are not aware about the best yielding fixed deposits of the banks available in the market. B, they are not aware of the DICGC insurance that the RBI provides, where investments up to 5 lakhs are insured. And C, there is a lack of access for people to choose the highest rate FD available in the market and then invest. So what we are doing is we want to get multiple such banks onto the platform, provide the users with an experience where they can pick the highest return FD available in the country and book that within 3 minutes. And this also does not need a bank account, and the process would be very seamless. So that is on the FDs part. And the reason that we chose FDs at the moment is because the rates are at a 5-year high, and we believe the RBI is also going to reduce the rates maybe 6-8 months down the line. So this is the perfect time for this traditional investment option to come back and lapped up by the masses. And over the time, we want to take our users from FDs onto other fixed income investment opportunities like corporate bonds, where the return that they're going to make would be slightly higher. And 1 year down the line, we want to have the users to build a portfolio of fixed income products on our platform.
So at present, How many banks do you have partnerships with, and how are you looking to grow that and integrate your partnerships with RBI regulated institutes as well as banks by the end of next year?
Yes, so we currently have four partners on the app. We have a couple of NBFCs and a couple of banks. In the short run, we are going to take that up to around 10 in the next 2 months, and over the next 1 year, we target to take the number of banks and NBFCs to 25.
Just walk us through the opportunity, because it has a market size of 300 million Indians who are, of course, looking to add opportunities for low risk returns. How low do the investments start at for stable money, and how are you really making it more lucrative for investors across all walks of life to participate?
Yeah. So the minimum investment that would be possible on stable money is 1,000 rupees. And the biggest advantage for the masses right now is that without any effort, they can improve their FD returns by 1 or 2 percentage points. We see that currently the FDs are concentrated with the large banks, where the rate of interest does not go to a very high number. They saturate at around 7.5%. The partners that we have, provide interest rates up to 8.5 to 9%. So this is an easy 2%, jump in the interest rate that the masses can get. And if you look at it from a 3-year FD perspective, you get an additional return of 6%. And in terms of the opportunity in India, fixed deposits is the most invested, instrument. But I think it is concentrated amongst the old generation of investors. We want to modernize that, digitize that, and bring it to the new set of investors who've come up in India.
What about the kind of competition? Because there are a few other startups as well who are working in the fixed income investment opportunity space. How are you looking to stand out, to differentiate yourself, retain your market share? What's the USP?
So the competition on fixed income front generally focuses on bringing the high risk, high return kind of products. Our approach is going to start from very, very low risk and very decent return kind of opportunities. So we as Stable Money want to focus on return of capital first and then return on capital. And on the FD front, we do not currently have any player who is planning to partner with such a large number of banks that our investors or clients need not go to any other platform to book any such instrument.
So what kind of margins do you work with currently? And as you gain more volume of customers and get commissions from your banking partners, where do you see your margins headed?
So currently we are not focused on the margins. I think we are only looking to onboard as many banking partners as possible and give the best investment experience to the customers. And once we achieve that sizable scale and become India's biggest fixed income platform is when we'll start focusing on the margins.
And Harish, just walk us through how you're really looking at the overall, leveraging your expertise and growing the business. What's the long-term vision down the line? Are you currently profitable, and what is the revenue run rate that you enjoy?
So we've just launched a few days back. So at the moment, we're not profitable.
Okay, fair enough. Good to have you on board. Thanks so much for joining in and wishing you all the very best.
Thank you. Thanks a lot.
All right, let's move right on then and put the spotlight on PB Fintech. The company has released their quarterly numbers where the net consolidated loss has narrowed to about 12 crore rupees from an earlier 204 crores that they posted last year. What has really aided the numbers? Let's find out. My colleague Vamakshi joins in with an update. Vamakshi?
Well, yes, a strong set of numbers is what PB Fintech has reported this time around. In fact, the company has reported a very strong quarter, especially for their core business. Core online business revenue has seen an uptick of almost 39% on a year-on-year basis, standing at 516 odd crores. Adjusted EBITDA has also come into the positive territory, standing at 23 crores as compared to a loss of almost 66 crore that the company had posted in the same quarter last year. Their core online business adjusted EBITDA also grew, standing at 69 crores, and this came in with a margin of almost 13% as compared to a 1% margin that the company posted in the same quarter last year. Consolidated PAT losses also narrowed down from the company from 204 odd crores to 12 crores. So definitely the company is inching towards the profitability mark as well. On the other hand, we also have a brokerage note that came in from Morgan Stanley, and they have highlighted that it was a very strong quarter for the company, especially for the core business. They believe that the growth that we did see in PB Fintech was mainly driven by the very strong core business. In fact, despite the first quarter being seasonally weak, the core business showed an expansion on a sequential basis in both the core revenues as well as on the adjusted EBITDA front. The contribution margin, especially the adjusted EBITDA margin, also improved further, and in fact both of these are at the best ever levels for PB Fintech. So all in all, on the back of that, Morgan Stanley maintained an overweight call on PB Fintech given a target price of 810 rupees per share. So good set of numbers, and that is the reason why PB Fintech was in focus today.
And it's not PB Fintech alone. We've seen a lot of new age tech or fintech companies of late that have been very vigilant about curtailing their costs and moving on the path to profitability. In fact, my colleague Sharad Dubey joins in with a list of some of these companies and how they are clearly focusing on the path to profitability. Sharad?
Well, yes, in focus, we are having the new age tech stocks, be the listed or the unlisted space. And the entire focus has been on cost reduction and focusing on unit economics as well as maximizing their overall margin and the PAT profile. Now, important announcement coming in, Paytm achieved their operating profitability guidance 3 quarters before what their guidance was, and this was achieved in the third quarter of FY23. While recently Zomato also turned profitable for the first time since listing for the first quarter of FY24. Apart from Paytm and Zomato, we also have Nykaa, which the company itself has been profitable since its listing days. But there are 2 companies, especially in the listed space, which is PB Fintech and Delivery, which are still under their progress for their path to profitability. Apart from this, Meesho, which is expected to come in for the IPO for the next 12 to 8 months, they also delivered in a statement that for the month of July itself, they have turned PAT positive. So a slew of important announcements coming in where unicorns and large tech companies which are listed are showing their path to profitability. Now, of course, the important reason is the cost-cutting measures are being undertaken, and a lot of acquisitions are also being written off as well. Apart from this, going into the details, do remember Paytm's EBITDA before the ESOP adjustment has been positive for the last 3 quarters, and also Nykaa is expecting that the costs, they're expected to come down by 10% going forward. But there are 2 companies which are having the status in the progress, and I'd like to point out Policy Bazaar, we are expecting at least 2 to 3 years, then the profitability will hit the company. And lastly, Delivery, recently they came out with their numbers as well. The numbers were largely in line with what the street was expecting, and they expect that they aim to be profitable in the next few quarters. However, if you look at their express business, they are already profitable in that segment.
Thanks very much, Sharad, for those details. Moving right on then, on Monday you had the Lok Sabha, which passed the Digital Personal Data Protection Bill, which actually lays down the obligations of entities that are handling and processing data as well as the rights of an individual. Let's delve deeper and understand the implications of this. My colleague Sumita Karir joins in with those details. Sumita?
Right, so the Digital Personal Data Protection Bill, or DPDP, got passed in Lok Sabha. Union Minister Ashwini Vaishnav, while addressing the concerns of the opposition, stated that the bill remains focused on principles of privacy and protection of user data online, even as the world becomes hyper-connected online. He also stated that the bill has been drafted after extensive public consultations with around 48 organizations and 39 ministries. Remember, opposition parties have been attacking the government on the alleged dilution of the right to privacy and RTI. The Union Minister, allaying those concerns, said that privacy principles mentioned in the Puttaswamy judgment on the right to privacy have been included as well. And dismissing allegations of exemptions in the bill given to government's agencies, Minister Vaishnav also stated that while Europe's data protection regulation or GDPR gives 16 exemptions to the government, India has given only 4 exemptions, and those exemptions pertain to unusual situations like calamities or disasters. Remember, the Digital Personal Data Protection Bill focuses on some key principles of legality, data minimization, which underlines that data should be collected only for the purpose for which it's intended for which it's recorded. The bill also puts restrictions on a period for restoring data, including putting obligations on platforms to safeguard user data. And very importantly, the bill, as the minister said, allows for voluntary and speedy dispute resolution that could be undertaken by the Data Protection Board, even as India's internet economy is projected to reach $1 trillion by 2030. So this bill ticks all the right boxes and perhaps is a comprehensive regulation that needs to be passed.
Let's also hear it out from Ashwini Vaishnav as he shares his outlook on the Digital Personal Data Protection Bill.
इस बिल में 140 करोड़ देशवासियों के डिजिटल पर्सनल डेटा की सुरक्षा की व्यवस्था की गई है। बहुत अच्छा रहता अगर विपक्ष इस पे अच्छी चर्चा करता, लेकिन विपक्ष के किसी भी सदस्य को, किसी भी नेता को नागरिकों के अधिकार के बारे में कोई चिंता नहीं है। इसलिए ये केवल नारे लगाने में लगे हैं, इनको चर्चा में कोई रुचि नहीं है, सारांश लाने की जरूरत नहीं है। नौजवान एक नई प्रगति की तरफ चाहते हैं, ये नकारात्मक राजनीति की तरफ किसी का कोई ध्यान नहीं है। लोग आगे बढ़ना चाहते हैं, इस तरह की नकारात्मक राजनीति लोगों को स्वीकार्य नहीं है। ऐसे में आज नागरिकों के 140 करोड़ देशवासियों के अधिकार के लिए जो ये बिल लाया गया है, रोड़े अटकाने वाले लोग हैं, हो सकता है अगली बार उनको ये मौका भी जनता न दे। तो माननीय अध्यक्ष जी, मैं निवेदन करता हूँ इस बिल को सर्वसम्मति से पास किया जाए।
Moving right on then, my colleague Sumita also caught up with some startups during the Semicon event. Let's hear them out.
India has always been looked upon as a services partner or a services game, but today we are able to see beyond that. We are able to figure out we can do designs, we can do chips, manufacturing, we can do testing, validations, all of that within India, right? So we are not just a services body shop, but we can actually have complete product life cycles start happening here. And that's the vision that this entire event is sort of inculcating in us. Now at Encore, we are a fabulous semiconductor startup out of Chennai. Our roots are from IIT Madras. The co-founders were also part of the initial Shakti program at IIT Madras in 2012, which was completely open source, and we did our first processor designs there. Encore is mainly focusing on building RISC-V based processors, which can target the embedded systems. Products like energy meters, smart cards, BLDC fans, BMS, battery management systems, for example. These are the places that we would like to see chips, indigenous chips, and possibly, push the government with the aim of doing import substitution in these verticals. That's what we are looking for, and that's where we see a good potential for Encore to succeed.
It's not a very easy thing to sort of, set up a semiconductor industry because of the inherent challenges, right? It's a very time-intensive industry. Experts have told us that it takes around 8 to 10 years for an entire ecosystem to come up. And then there is humongous investments to be made as well. Do you want to take us through some of the challenges and how India is equipped to handle those challenges? I mean the startups, the industry.
So I can talk about the challenges that we as a fabless semi startup will typically have, or other players like us would be facing. Is a typical life cycle for us is getting the first design out. It's usually 18 to 24 months, right? And that's intensive capital purely from the labor perspective.
But why does that take 18 to 24 months?
That's the kind of confidence that you need to build. So to give you an example, if a single chip, which is, let's say it's sold 1 million pieces, right? If it goes wrong, you've lost the market. So by getting a wrong chip or getting a wrong design out, it's not just your brand value goes down, but you got to recall those pieces, right? For example, the famous Intel bug, FPU bug. It had to recall all of those chips, even whether the flaw was being used or utilized, not utilized. They still had to recall those chips. So it was $1 billion down, a cost that they had to pay, right, in the orders of millions. So there's a fear that if you don't test enough, if you don't validate and have confidence that the chip actually is supposed to do what it's supposed to do, you don't want to go out and make a chip or a product out of it.
There are a couple of things involved in the chip, the IP, the design, and then the chip fabrication, assembly, test, and supply chain. So the companies what you mentioned, they're all major semiconductor players. They feel some of these things. For a startup company like us, naturally we cannot have the fab. We are called a fabless semiconductor companies. What it means, we do not own the fab, but we expect there are standard fabrication facility available where we can submit our designs, get the wafers, and then service a segment.
So that's how you are planning to contribute to the overall Indian chip market?
Definitely. Once the industry grows, we can make a variety of chips. We can integrate them. We can start doing different SOCs, as they call system on a chip, or SIP, system in package, and then we can deliver to the respective customers.
Right. But sir, it's often said by experts that chip making is a very, very capital intensive business. It's also a time taking business because it usually takes about 8 to 10 years for results to actually show. How do you think, Indian players, big or small, are geared up for that challenge?
See, one is the technology and design. Definitely, as you rightly said, setting up fabs are a very capital intensive and time intensive. That means we need to have a real long-term strategy. Country of our size, economy of our size, and given the geopolitical issues, we certainly need to go, and government is the right partner to drive this. Once the ecosystem is there, where you have fabs, where you have the assembly test facilities, raw material availability, it improves the overall situation, and India can be a major player in this segment. But one fact is very important, given the size of our economy and the number of consumers here, the electronic content we are consuming, whether it is in our homes or in our automobiles or in our working environment, is huge. I don't have to name, right from your Bluetooth, Wi-Fi, smart mobile, everything requires somewhere underlying hardware. So these are all cutting edge technology. And when other countries are possessing and we do not have it, we will be perennially at a disadvantage if we don't take right steps now. Else we will become a net importing country of these.
Let's listen in to what Sridhar Sivaram then of Enam had to say about his outlook on companies cleaning up their act and focusing on generating profits. Does this mean that the investment thesis for it has only gotten better? Let's hear out what he has to say.
So actually, in the last 6 months, we've been engaging with many of these new age companies, as we will put it. I mean, in 21, when they listed, we really didn't understand the valuation, the business model. And many of them didn't want to engage with smaller investors like us because a lot of the FIs were putting in money. No, but now the business models have changed. So if you see, all of them are talking path to profitability, and we can clearly see path to profitability in many of them. And we've changed our views and we've invested in a few of them.
And on that note then, we're out of time on this edition of Startup Central. Thanks for watching.